Okay, welcome everyone. We'll start lesson 4. Today lesson will go through LO4. As you know me, my name is Anjum Satta. Please, if you have any question, drop me email anjum@ukversity.co.uk. Today lesson key focus will be short-term and long-term different sources of finance, which is our part of LO4, be able to recommend effective long-term and short-term sources of finance. So when we'll say long-term, it means more than a year. Short-term is less than a year. So uh, I'll will also go through debt financing and equity financing. Debt is better than equity because that's less costly than equity financing. Because when you have a debt financing, is mean bank loan, mortgage, overdraft. These are all is a debt financing. So when we have a debt financing, any interest we paid is expense for business. We minus from profit and loss, and then we can save on the taxes. But if it's a equity financing, you have to pay all. You have to pay the tax. You have to pay all the expenses afterwards. Whatever will be left, you have to pay to the shareholder. So there is a no tax saving. So that's normally we lot of analysts and we say that is better than, but we need a good balance because otherwise your gearing ratio will be high gear higher. So a couple of you learn in our ratio analysis we discuss about gearing ratio. It's mean high gear high risk. That will be our in discussion. Today lesson we have key command verb assess, reflect and appraise. That will be in our discussion, which we'll go through. Okay, guys. So next now, indicative content, what we're supposed to be. Sources of finance, yes. Financial resources, type of fund, short-term, long-term, which we'll go through. Sourcing funds internally, externally, venture capitalists, leverage, risk. Risk is mean probability of happening something, cost, and the benefit. That all will be in our discussion today lesson, the key. Okay, we'll do a bit recap what we learned during our previous lesson. So lesson 1, we discuss about types of costs. We discuss about variable cost, the cost which change with the level of output. We discuss about fixed cost which stay the same. Semi-variable is the cost which change with the level of which is a fixed and variable together. Opportunity cost. Opportunity mean if you are willing one thing, you're missing other thing. That's we call opportunity. Yeah? So if you are attending this course, you're missing the opportunity to earn. So we need to be look around the opportunity you're taking has the more benefit compared to the opportunities which you're missing. The benefit should be higher than the opportunity we avail, the opportunity we miss. Okay, standard costing, we discuss about, we set the standard and then we compare with the way budgeted versus actual. We said we can calculate the variance. ABC is known as activity-based costing, absorption costing, and marginal costing. So all need to be focused in our discussion, which we discussed in the previously as a absorption costing known as the full cost, and marginal costing is known as the variable cost. Budget type we discuss second, the third lesson more about the budget types of budget. We discuss fixed budget which stay the same, flex which change with the level of output, activity based. If you have more activities, you have this is the margin costing method as well. Activity based costing, we have a cost driver. So if you have more activities, you have to pay the more cost. Master budget is mean overall the budget, which we can summarize into financial statement like your income and expense, like your assets, liabilities, and capital. And financial management, we discuss difference between financial managers and financial management and financial accounting in our lesson 1, internal external budget and financial accounting required standards. So we discuss about financial statement, 4 types of financial statement we prepare in account: statement of comprehensive income, statement of financial position, statement of cash flow, and statement of change in equity. So, and measure the performance. That's what the key in our previous lesson. Today lesson is more about funding. Okay, let's please. Can you reflect, sources of finance? Always, what are those? Why is good? Do we have that knowledge? What sort of the things we need to be keep in mind when we Okay, so always we looking risk and return of each source. Risk in mean probability of happening. Debt financing, bank loan, VC equity financing is shares. Debt is cheaper than source of finance and equity is costly. Gearing ratio high risk, balance approach and equity 60 to 40%. So 60% debt, 40% equity is better, or around 55 to 45 that can be, depends industry to industry. Okay, so 4.1, assess the need of the short-term working capital. Working capital, also known as the running capital and long-term funds. Often, the hardest part of the starting business to raising the money to get going and entrepreneurial or the business owner is greater ideas, clear ideas to be turned the success business. However, the sufficient fund cannot be raised. It is unlikely the business will get off around and raising finance startup required careful planning and entrepreneurial need to decide how much finance is required, when and how long the finance is needed, what security, if any, can be provided, and whether the entrepreneurial is prepared to give up some control ownership to the startup in return investment. Finance need to be startup and should be account for these, in the area setup costs. Yes, what if you want to be set up the business, what cost will be, what money required to be set up the business. Starting investment in capacity, yes, the fixed assets that are the business need before it can be traded. Working capital is known as the running capital, the stock needed to be by businesses, raw material allowance amount, and that will be honored by the customer. And once sales begin, growth development capacity, all we need to be types of ownership. Also keep in mind what type of business you have. We discuss sole trader, 1% business, partnership 2 to 20, limited company, it can be private, public limited, always linked, and the charity, non-profit organization. Always look mission, visions, value, corporate objective where you want. When we say working capital, is mean debt, trade receivable days, uh, creditors, or we call trade payable days, plus inventory turnover days and minus trade payable days. So you can get it how many days, the working capital cycle. Okay, so that's, which we will look around. So pay per days is quite expensive source of finance. Always look the base rate, which is set by the Central Bank of England. At the moment, base rate in UK is 4.5%, which is went up in the previous year. Gen rate was 0.01. It's quite huge, So business has a variety of the choice. It can be make about how it can obtain the source of finance need to be. A business need to assess, different types of finance based of the following amount of the money required. Thus, you need to be make sure how much money required, how quickly the money is needed. Because if you have a money but you don't need it, it's cost you from the day first. So be careful. Don't borrow until you have actually start your work. Or you borrow in chunks. Yes, small proportion of it when you need it, because otherwise it can cost you. The cheapest option available, the cost finance, is normally made in terms of extra money that need to be paid to secure the initial amount. The typical cost of interest that we paid borrowed amount, and the cheapest form of the money is the business form is trading profit. So that's we need to be keep in mind. Okay, sources sources of finance, always look around, the amount of the risk involved, the reason for the cash, the project which had the less chance of leading the profit is deemed to be more risky than one that does. Yes, potential sources of finance, especially external source, take in account or may not lend money for the higher risk businesses project unless some are sort of the guarantees available these project in return. The length of the time, the requirement for the finance, a good entrepreneurial will judge whether the finance is needed is for the long-term project or the short-term, and therefore decide, whether type of the finance wish to use. Thus we need to. Okay, short-term and long-term. Short-term finance is needed to cover the day-to-day running business, and it will be paid back in the short period of time, and so less risk for the lenders. So long-term finance tend to be spent, on the large project that will pay back over a long period of time. So more risk. So the lender tend to be asked, some form of insurance or security if the company is unable to repay the loan. A mortgage is example of secured long-term finance, and the main sources of short-term finance are overdraft, suppliers, credit, and working capital. That's we need to be well aware of. Okay, long-term source of finance. The main types of long-term source of finance that are available is for business are mortgages, bank loan, share issue, debenture, return, profit hire purchase, and repay interest is only different in different terms. The cost and benefit analysis, shares preference, ordinary shares, 5 to 10% dividend normally is the people are entitled in type of the shares. That's we need to be, and these are all sources of finance. In the short run, in the short term, the business can raise the finance through the overdraft. Yes, like day in and out, and overdraft carry on. It normally is a high fees. Overdraft are very flexible and can be arranged quickly and can be repaid quickly. Inform the company can afford to do so. However, the bank chooses to, and it withdraw overdraft facility at any time, which could leave the company in the financial trouble. And the short-term loan is the more formal arrangement, and which will be governed by an agreement, and which is specific exactly the amount should be paid and when and what interest will be. That's we need to be look around working capital. What is the working capital? Is the capital available to conduct day-to-day business operation, normally excess of amount of asset over the excess of liabilities. Working management is the management of all aspect of the both, current asset. Current asset mean is inventory, trade receivables, stock. These are all current asset. And current liability, creditors, trade payable, we call them overdraft. So these are your short-term liability to minimize the risk insolvency to maximize the return. The main objective of the working capital arrangement is to get the balance of the current asset over the current liability. That's we need to be good balance. Okay, sources of finance, as we said, long-term, medium-term, and short-term. You can divide it according to duration. It can be varies industry to industry as well. Share capital, bank loan, bank overdraft, return profit, it means the previous year income, leasing, trade creditors, can release venture capital, hire purchase, and short term, and mortgage, which is yes, we can borrow property, especially buy properties again, the mortgage, our asset, and then government grant and factoring. Yes, if you have a previous year invoices, we can discount. Okay, so external sources, each of them its own advantages and disadvantages. So always businesses owner need to be kept in mind each advantages. So this is the good way to cover the period between the money going out and the money coming in to short-term bank overdraft, disadvantage, interest rate payable on the amount withdrawn, and expensive to use our long-term. Okay, so borrowing from the bank and type of banks, banking system, it's clearing bank, retail bank, merchant bank. They all provide the loans and they provide the payment mechanism, provide the place of the store, the people, individual, and the firm's wealth and lending. These are all the banks, and they are also offering the sources of finance. So we need to be look around this side. Borrowing money, bank will lend you the money only if there will be a repaid within the reasonable time. They will make more themselves by lending to you and making you to pay interest, and then would be more doing something else with the money. They apply well tested the principle. Additional partners can be in a business. If you want to be, if you have a business is, let's say, partnership, so does not have to be repaid, no interest is payable, can be, yes, diluting control, you have more people control now, and profit will be split into. Okay, share issues, yes, share can be issued, doesn't have to pay the repaid. If you don't earn the profit, you don't pay, no interest is payable, and disadvantage, profit will paid out as the dividend more to the shareholders, and the ownership of the company could be changed in the hands Leasing, a business can have to use the lease and the date of the equipment immediate and the payment is spread over the period of time, which is good for the budgeting and can be expensive disadvantage in the asset belong to the finance company. Yeah? So we can do the leasing. Leasing can be two types. It can be finance lease and operating lease. Finance lease is under the finance lease, the title of the asset will be yours from the day first, but under the operating lease, you carry on paying like interest. So hire purchase agreement, this method of business obtain the asset without need to be paid the large sum, involve the paying initial deposit and regular payment can be and make difference between the hire purchase and leasing and a purchase after the repayments can be. So we can look around the purchase businesses can have a use of date of equipment when immediately payment is separate, the period and when the repayments is made, the business will own its asset and disadvantage. This is expensive method and compared to other. We always do the cost and benefit analysis of each. Okay, mortgage. This is the loan secured against the property and repaid in installment. It can be higher period of time. That's why we call long term. It can be the mortgage can be fixed, tracker, uh, are flexible and change with the interest rate when base rate change. That's you need to be business has to use the property payment can be separate the period of time and once the repayment is made, the business asset will be on the asset depend upon the nature of the mortgage is the repaid. And this is the expensive method compared to the buying with the cash. And if the business does not keep the repayment, the property can be possessed. Trade credit can other ways to borrow the money. Yes, the business can sell the goods first and pay them later, which is most of supermarket and the goods for the cash and no interest is charged and the money is paid within the agreed term. That's which is the advantage of it, which we need to look around. And the discount given for the cash payment would be the lost, and the businesses need to be carefully manage their cash and flow to ensure they will have a money available and when the debt is due. That's all we need to be well aware of. Okay, so government grant, government organization offer the grant to the businesses and both establish new and usually certain condition and apply such where the business is located, grant to be ensured the innovation, research, development, economics, regeneration, and business risk. And the small farm loan guaranteed schemes can be in regions development agencies, no deal that they don't have to be repaid and disadvantaged. Certain condition may be applied to locate the government grant and government can be get the benefit in terms of their taxes. Venture capital is pooling the capital into the form of limited companies and venture capital looking to investment opportunity in the fast growing businesses with a higher rated prospect and may also buy out the firm in administration who is going to be concerned. May also provide advice to be conduct and experience in UK and venture capitalists have the invested 50 billion since so that's a huge small so we can look around factor affecting the sources of finance. Always look around the purpose why the money we need to be borrowed, time limit we need to be look around, amount how much we are borrowing, and types of ownership of the business because it's impact your. Always keep in mind the tax and the rules as well. Okay, 4.3, we are looking justify the choices of the sources of funds using the range of criteria. So we can look around capital expenditure. Okay, guys need to be well aware of two different terminology we use. Capital expenditures mean the asset we are going to buy is like a property, the investment which we are going to be invest money into. Like, if you extend your house, to acquire, improve the asset held over the long non-current asset. Non-current asset mean like property, plant, equipment are known as a fixed asset which we can use number of years. If you find the balance sheet of the company of your choice under this, you can find the different sort of asset and non-current asset is if when you're spending money on these known as a capital expenditures. Okay, so revenue expenditure, which is is respect of the purchases and expenses of the businesses and increase expenses in the ledger accounts. Like, this is also known as short-term value asset, like a cleaning, like a maintenance, like these are the expenditures, the revenue. Capital income, when you're selling the asset, you have a gain, and that's your called capital income when you sell the non-current assets. Revenue, when you sell the current asset or you make, the selling the goods which you purchase and sell, that will be known as revenue income. And we pay the taxes on it. That's, these are, we can look around when we have a source of finance, we borrow money. So when we looking the source of finance, equity and others under internally generated return, ordinary shares, that's the capital market where we issue, and the money market is the long-term debenture preference, medium-term leasing, short-term trade creditor, overdraft, or special purpose of the government grants. That's what we categorize. So please, when we borrow money, all and we need to access, the risk, what will be the existing shareholder have a right to subscribe the new shares issue in the proportion of the existing holding. Theoretical X price, value of existing share plus the proceed from issue divided by the number of shares issue after the right issue. Number of shares issue after the right issue. Value of right, the value of the right is minus the issue price. Thus we can, and value of the right for existing shares, value of right divided by the number of shares needed to be have the right. That's, which we need to, we can calculate, and then we can decide it's a good option. Debt versus equity, as we mentioned earlier, the equity share is owned by the business and having the voting right. The debt holders higher in the priority of the payment than the shareholder. The risk, debt, low risk of the debt holders, high risk of the company. Equity, high risk of the shareholders and low risk for the company return. And debt holders will accept the lower return due to the lower risk and cheaper for company, and the equity shareholder want higher return to compensate higher risk and more expensive for the company. So that's, which we can look around the which proportion or which source of finance is better for the company, and then you can decide. SMEs, also known as small medium enterprise, can have a difficult raising finance, can be small number of owners with a limited capital, lack of business history, proven track record, and lower level of security. Funding gap is difficult in raising finance, yes, for the above reason, and maturity gap, it's either raising long-term finance, secure again the long-term asset. Short-term finance may be preferred, and the sources of finance, SMEs, business angels, which is the rich people, venture capitalists, most of the company come and yes, invest in the various projects, government assistance, supply chain financing, like, and crowdfunding. Okay, so always, guys, it's quite good to be look around the weighted average cost of capital. The steps, calculate the weighted average of each source of capital, estimate the cost of each source, multiply the weighted average source of capital by its cost and sum. So we can look around the value of equity divided by value of equity plus value of debt. K is the cost of equity plus value of debt divided by value of equity plus value of debt. KD is the value is cost of debt 1 minus T. That's, formula we looking, and we carry on using the cost of equity post tax. So we can look around the cost of debt equal to 1 minus T. T is the tax. So please, that's we'll carry on, and we're using the formula to calculate the what is the averagely cost and what is the averagely you save. And this is the link. Please, it's good to watch the video on the sources of finance in your time, enhance your understanding. There's an article on the sources of finance. Please, good to read. And you can do the quiz, different sources of finance when you develop your understanding, watching these video and developing your knowledge, and then you can test your knowledge. So if you went wrong, at the end will show you reviews, and then you can review the sources of finance. Great. Thanks for anyone, any question, guys? If anyone any question you can ask, otherwise we'll keep up to here. In the next lesson, we'll go through LO5 learning outcome 5, and then we'll do the assignment decision. Thanks for attending today's session, and hope so I'll speak to you during our next lesson. Thank you. Bye-bye.